At the turn of the 20th century, America was a land of limitless possibility. The skyline rose with steel and ambition, bold, daring, and unstoppable. Fueled by the American dream, small-town entrepreneurs built companies that reshaped industries and uplifted their communities. Innovation became the heartbeat of our nation. In 1912, local business leaders united with a shared purpose: to create a single voice dedicated to defending free enterprise, empowering businesses to serve people, provide solutions, and strengthen society. That voice became the U.S. Chamber of Commerce, committed to advancing economic freedom and opportunity for every American. For over a century, we've been a driving force at the crossroads of progress, shattering barriers, fueling growth, and creating opportunities for people building better lives. We don't just support business, we ignite it. From local startups to global enterprises, we create an environment where potential thrives, empowering communities, leaders, and creators to transform bold ideas into lasting impact. Working with and for a local, national, and global federation of partners, we fight for American businesses in the courts, in state capitals, in Washington, and on the world stage. Steadfast in our principles, unwavering in our resolve, uncompromising in doing what's right. This is America's story, written with vision, bound by conviction, illustrated through courage, and enriched by the hard work of everyday people, local business owners, and global visionaries who continue to define us. It's an enduring legacy of strength, determination, and shared ambition. One we proudly build upon as we work to write the next chapter of our nation's story. Join us. Together, let's build a future of growth and opportunity for the pursuit.
Good afternoon, everyone, and welcome to the Free Enterprise Exchange. Defending, protecting, and advancing free enterprise is the U.S. Chamber's 114-year mission. To that end, we created this platform to address common myths, explore emerging trends, and provide timely insights that will help us all to promote and uphold the values of the free enterprise system. Today, we're exploring a particularly timely topic: how do pro-growth tax policies unlock opportunity for all Americans? We'll hear from Neil Bradley, the Chamber's Chief Policy Officer, who will lead a conversation with Daniel Bunn of the Tax Foundation on how tax policy can be a powerful tool for economic growth, innovation, and opportunity. Daniel Bunn is the president and CEO of the Tax Foundation, a role he's held since 2022. He joined the organization in 2018 and successfully built its Center for Global Tax Policy, expanding the foundation's reach and impact around the world. If you're tuning in via YouTube, you'll find a link in the description box labeled "Submit a Question" if you'd like to pose a question to either of our panelists. We'll first hear from Neil and Daniel, and then we'll get to audience questions at the end of the conversation. Looking ahead, we'd love for you to mark your calendar for the next installment of the Free Enterprise Exchange series, which will be held at the U.S. Chamber headquarters on October 17th. For that conversation, we're thrilled to welcome two leading voices in economic theory, former Senator Phil Gramm and Donald Boudreaux of the George Mason University, to discuss their recent book, The Triumph of Economic Freedom. We encourage you to register on the U.S. Chamber's website and join us for another insightful conversation. With that, I'll turn things over to Neil and Daniel for a great chat.
Eric, thank you so much, and thanks to all of you for joining us today. I couldn't be more delighted to welcome my friend Daniel Bunn into the Free Enterprise Exchange. Daniel, welcome.
Thanks so much, Neil. It's great to be here. Thank you for having me.
Well, let's start with a little bit about the Tax Foundation. What is the Tax Foundation, and what do you all do?
That's a great question, Neil. I get this regularly. So Tax Foundation is a think tank. which then a lot of times I get questions of, well, what is a think tank? We're a nonprofit research organization based in DC. We've been around since 1937, and we take an approach to tax policy that uses economics and principles to help policymakers at the US federal level, state level, and international level understand the consequences of their choices. And we also do a lot of public education to help individual taxpayers and lawmakers understand the different intricacies of the tax code. One of the things that we really do very well is that we use an economic model to help lawmakers in Washington, D.C. evaluate their choices of tax policy, impacts on revenue, impacts on growth, investment, jobs, etc., to help them think through, well, if there's a choice that could be made to move the economy in a better direction, let's make that choice rather than a choice that would be harmful to long-term economic growth. The principles that we care about are rarely found in tax codes, but we still care about them. Simplicity, stability, transparency, and neutrality. And, every once in a while we see a lawmaker saying, well, actually, we should make things simpler or more neutral. And we certainly love to see it when that happens. But like I said, most tax codes are pretty complex and don't align with our principles. So that's a little bit about what we are. We've got about 40 folks on the team doing work, like I said, in DC, around the nation, and internationally.
So I think it was Ben Franklin who quipped that the only two certainties in life are death and taxes. And
yes,
death feels very binary. You're either alive or you're dead. Taxes is not quite the same way. And so I infer from your description of the Tax Foundation that part of it's premised on the idea that not all tax revenues created equal. Of course, the government has to raise revenue. Taxes are a fact of life because the government needs revenue to function. But the different kinds of taxes that the government can impose can have dramatically different effects on the economy. Can you share a little bit about the different types of taxes broadly and how they impact an economy?
Yeah, absolutely. So the way we think about different tax types and their impacts is we think about the economic distortion that comes from placing a tax. So anytime you put a tax in place, it's going to cause some behavior to shift. Somebody's going to make a different choice than they otherwise would, but we try to aim for tax policies that minimize those distortions. So for instance, if you have an income tax, that might change the decision of whether you're going to work or not, or how much you might work. And especially if the rate is very high, you might say, well, it's probably worth working less rather than paying a lot more because I'm, taking overtime shifts or things of that nature. When it comes to consumption taxes, we think about sales taxes as a relatively efficient tax. You're certainly going to see people make decisions around what things they're going to buy in relation to the sales tax that's applied. But generally speaking, people have to consume something. They have to purchase something. So when you apply a sales tax, you're not necessarily distorting as much as you might be with an income tax. And then property taxes are even more efficient in the sense that you're not going to distort as much of the decision to own or buy property because the property is immobile. Like you probably need a place to live. Businesses need a place of operations unless you're totally in the cloud these days. And even then you need the property for your data centers. But the property tax is one of the least restrictive taxes when it comes to long-term economic growth. At the other end of the spectrum are taxes on businesses. And taxes on businesses can be particularly harmful to growth because they impact decisions to invest. And investment is an engine for long-term growth. If businesses aren't innovating, aren't investing, individuals might not have as many opportunities in the workplace. There might not be as many opportunities for different products. So making sure that the business tax code does not stand in the way of new investments is really critical. But that's an area where you're playing around with a piece of tax policy that's more likely to damage economic outcomes than with consumption taxes, sales taxes, or property taxes.
Yeah, I want to come back to investment taxes in a moment because you're exactly right. From the U.S. Chamber's perspective, it's one of the most important areas in the entire tax code to get right. And I want to explore that a little bit with you. But before we go there, when you brought up the question of distortions, You were talking about kind of the broad applicability. So if there's a sales tax and it's applied on everything, you got to consume something. So the government's not incenting you to buy this widget versus this experience, for example. But sometimes taxes can be designed to effectively pick winners and losers. Talk a little bit about what that looks like and what that does to a free market economy.
You're absolutely right. And this is what I was talking about, referencing earlier when I said our principles are rarely represented in government policy. And this is the principle of neutrality that we really search for opportunities to help lawmakers understand the importance of making sure that the government isn't selecting winners or losers. One of the things that we look at in this context are very clear incentives that governments design for different products or services where, in a sales tax, you may say, well, this type of food is going to get an exemption. We're going to subsidize that. Or this type of service is going to get an exemption. Or sometimes a product might see a higher tax rate. There's these things called sin taxes, where taxes on alcohol or tobacco products, lawmakers often want to levy higher taxes on those products. What that does, to your question, in a free market economy, is it changes the behavior of individuals, it changes the behavior of businesses, and it makes things a little bit more complicated for complying with the tax code. Essentially, what the government's doing is saying, we want actors in the economy, individuals, families, businesses, to follow a certain path rather than an alternative path. And the tool that they're using to determine that is the tax code, and say, well, we're not going to outlaw this activity, but we are going to make it cost more for you. We also see this in business taxes. One of the things that we've seen in recent years is a difference in different political actors saying, well, in some cases, we want to subsidize certain types of energy production, and well, we want to penalize other types of energy production. From my perspective, the tax code should not be making those decisions for people. And honestly, it hinders both the sometimes well-meaning goals to use the tax code in that direction, and it hurts consumers, hurts the broader economy by having the government stand in the way and say, well, we're going to pick the path for the economy with the tax code.
Yeah, in some instances, the government's literally saying, you're in a good business, you're in a bad business.
Exactly.
If you're in a good business, you get a tax cut. And if you're in a bad business, you might get a tax increase. And that's, we don't think of taxing necessarily as kind of a regulatory power, but in that way, it's like the most powerful regulatory tool in the world, because it's the ability to either reward or destroy. I want to go back to investments for a second, because as I mentioned, we think this is one of the most important areas of the tax code. But maybe let's start with just a baseline. How is it that taxes might impact the investment decisions that a business makes? And why do those investment decisions actually matter for the economy?
Yeah, so the tax code impacts these decisions through usually the corporate income tax, but also a lot of closely held businesses pay taxes on the individual income tax schedule. And that word that I'm using, income, is defined in the tax code to include the revenue that you earn minus expenses, and expenses includes all sorts of different things. And there's all sorts of different definitions and restrictions for the different expenses you're able to use to deduct against your revenue to end up with your taxable income. And what businesses have to do is they have to pay taxes on that income annually. And when a business, and sometimes you have to file quarterly returns and things of that nature as well, depending on where you are. But the challenge that creates for investment is a lot of times the earnings that businesses use is reinvested in the business. But if the government is saying, well, regardless of what you're planning to use the money for, we're going to take a slice out of that, and that immediately distorts the amount of capital that might be available for reinvesting in the business. Additionally, the tax code looks at different expenses and says, well, some things you can deduct immediately, other things you have to deduct over the course of time. The big beautiful bill from earlier this year fixed a lot of these things, but this can really impact the ability of a business to plan its investment and make sure that when it's spending money, that it's actually deducting the full value of that money and not having to wait 10 or 15 years to be able to deduct the value and actually losing some of the value of those deductions due to inflation or the time value of money. So both the tax on income, that annual tax on income, drives a wedge in investment decisions, and the definition of income, what expenses are allowed to be used to deduct against your revenue streams, can lead to a wedge on investment decision. And that means that a lot of times when a business is determining what to invest, or if there's a merger opportunity or a new acquisition or some growth plan, you have to take taxes into account. And certainly what I've described is really important, but another element is stability. If the tax system is going to move, this way, that way, there's a political change at the federal level or the state level, you have to take into account some kind of guesswork about what the future of the tax system might look like, and be able to help business leaders, investors, or decision makers to know how to deal with that uncertainty.
Yeah. So I want to talk a moment about how this type of investment drives an economy, because when we think about a growing economy, the economy just doesn't grow by itself, right? The economy grows because we have millions and millions of businesses and economic activity within the economy that themselves are growing. And the economy grows more quickly when you have more of those businesses and economic activities that are growing. If you think about some of those individual businesses, I'll use one of my favorite examples, a guy who owns a plumbing shop, and he's a one-man plumber. And it turns out that there's a lot of demand for his services. He wants to be able to expand, but a guy just showing up at your house isn't going to fix the plumbing. It takes a guy showing up in a truck with all the right tools and equipment to be able to help you fix your plumbing. Those things have costs, right? He has to buy the truck, he's got to buy the tools. And so the ability for him to expand is an expense that then allows the economy to grow. I think what you just described is two ways that the tax code can actually make it harder for our plumber to actually make that investment. One is that if the government's taking more of his profit and he just has less of it to reinvest in the business. The second is whether he gets to deduct that new truck and all of those tools, meaning whether the time value of money. Can you explain just a little bit more about how that works?
Yeah, absolutely. So to draw back a little bit on your example, I think it's a perfect encapsulation of what's very basic to economic growth. You need capital accumulation. You need the purchasing of equipment, expansion of a business in that direction, and you also need growth in skilled labor. We'll get into that angle in a little bit, I believe. But on the capital investment, a lot of times businesses are required to take 5-10 years to write off a new investment. So that van that the plumbing company might acquire in an expansion, say they've got an opportunity to meet more demand, more customers, they might need 2 or 3 vehicles for their service team to be able to reach out to their new customers. That business is going to have to pay the full cost of those vehicles in year one. It's not like the auto dealer is going to say, well, we're going to be able to, stretch this out over time. And maybe the business might be able to arrange some sort of lease agreement, but really that business is going to have to do a lot of shelling out of cash in year one. But the deductions for tax purposes aren't always aligned with that year one cost. And in fact, the business might have to wait 5 years to write off those costs in their taxes. That means that in those years, well, really in year one, there's a mismatch between actual revenue and actual cost. So the business is actually getting taxed on phantom income that hasn't really shown up yet because they're not able to deduct the full cost. And different states take a different approach to this. At the federal level, again, that has mostly been fixed. But there's always a threat that could come back, and businesses would then have to be able to not only shell out the cash in year one, but then have to delay the deductions over the course of several years.
So I want to make sure I get this right. Let's just use round figures. Let's say that a fully loaded plumber's truck costs $100,000. And so it's 2025. Yeah, I go spend $100,000 on this plumbing truck and all the equipment. If the tax code says that I have to deduct that over 5 years, let's just, for sake of argument, make it even. I spent $100,000 in the first year to buy the truck. The tax code says I get to deduct 1/5 of that amount, so $20,000, which means I pay taxes on that remaining $80,000 of kind of phantom income. The next year, I get to claim another $20,000. And so the time value of money means that $100,000 truck over the course of 5 years is actually going to cost me more money than the initial $100,000 if the tax code is treating these investments this way. Do I have that right?
Yeah, absolutely. That $20,000 write-off that you would take over the course of each of those 5 years, that really loses value. We know inflation this year is going to roughly average 3%. We've seen a lot of volatility in inflation in recent years. So 20,000 in 2025 is not 20,000 in 26 or 7 or 8 or on down the line. But these are fixed amounts that you would be able to write off because that $100,000 is spent in this year. So if you have $100,000 in revenue in 2025 and $100,000 expense in 2025, you end up with, like you said, $80,000 in phantom income. You're not actually earning $80,000 in net profit in 2025. You're paying taxes on $80,000 in phantom profit because of the way the tax code requires those payments to be allocated to your taxable income over time. Now, maybe we're going to get here shortly, but the fix to this is very, very straightforward, and that is something called full expensing. And that says essentially the plumber could write off the entire $100,000 in year one and not worry about having to track those amounts over time, not worry about having to pay pay tax on the phantom income, and it allows them to really match their real world expenses with the tax code in year one. Now, certainly, it's possible that if they have $100,000 in revenue and $100,000 in cost in year one, next year they're going to have $100,000 in revenue and maybe very little cost. So you have to certainly pay attention to the profit tax in years forward, but you don't have to track the complicated accounting rules over the course of time. I mean, this is a very simple example, but imagine if you are investing in dozens of different assets and each of those different assets had different time horizons and different rules for eligibility. So this is a dramatic simplification, and it allows for the tax code to be much more neutral to the decision of whether you're going to invest or not. It takes that wedge a little bit out of the decision of whether you're going to invest this year.
I'm so glad that's exactly where I wanted to go and why this was different. And for the audience, one of the reasons I wanted to explore this is because sometimes we talk to lawmakers who say, basically all tax cuts are the same, right? And they have the same economic impact. And we tried to simplify using our plumber example of this very complicated thing on capital cost recovery. But if you're an elected official, it's a lot easier to go out and say something like, hey, how about no tax on tips? And if you don't understand the economic ramifications of these particular policies, you might think that no tax on tips, which is pretty self-explanatory, has the exact same economic impact as what Daniel just described as full expensing. But of course, that's not the case. So Daniel, just the last point on this, help us understand a little bit about you've described full expensing and what that does, how it removes the punishment for investing in a business. Tell us a little bit about a policy like no tax on tips and what that does to the economy.
Yeah, that's a great question, Neil. No tax on tips. I think it's politically popular. We've seen bipartisan interest in this. Really what it does is it creates a very small tax cut for a very small slice of wages. So you think of workers throughout the economy. We have millions of workers, and many of them do not earn tips. In fact, the Treasury Department's putting regulations together to narrowly scope who might be eligible for no tax on tips. Now, for that small class of workers, you might see some individuals say, oh, well, I'm going to be eligible for this. I might be willing to stay in my tipped job longer or work more hours, or think about the approach that I take to serving customers to earn those tips. But that's a very small amount of change or benefit in the broader economy. Think about how that flows through to that person's individual economic footprint. Certainly, that person will have a little bit more take-home pay, a little more after-tax income, so that can influence their consumption. Might be able to afford a little bit larger house or better apartment. Might be able to do a few more interesting things on the consumption side of things. But there's not really anything that I would expect from no tax on tips to impact investment either in additional skills or additional capital, like we were talking about with the plumber. And those are the things that really move the economy forward: additional skills, more skilled workers, and more capital investment, like we were talking about with the plumber's vans. So it's really disappointing and frustrating to me when I see, the amount of revenue that's being spent on something like no tax on tips, when the economic bang for the buck is really quite tiny.
Yeah. So, okay, I want to shift gears a little bit, because we've been talking about a tax system like there's just one universal tax system. Of course, the reality is that we operate in a global world, and even within the United States, we operate within different state tax regimes. And sticking on the global level for a second, it can impact both business decisions and economic growth when one country has a more pro-growth tax code than another. And particularly thinking about a few years ago when the US had the highest corporate tax rate in the industrialized world. What does that do to the US economy, and why was it important that we have a globally competitive tax code?
That's a great question, Neil. So in our global system, there is a level of mobility for investment. So a company that wants to sell products in the United States does not actually have to operate in the United States. We have a global trading system that allows companies from around the world to find their way into selling into the United States. And a lot of U.S. companies certainly sell to U.S. consumers, but they might also sell to consumers abroad. And so the tax code, when you have a tax system that is more punitive to business activity, and you have a market that's kind of attractive for selling into, you might have a company that says, well, we don't have to be headquartered in the same country where our market is. And in fact, if the US is more punitive relative to, say, Canada or the United Kingdom or Ireland even, maybe it's a better opportunity to headquarter our company outside the US and be able to sell into the US market. Now, a lot of times what we see is different mergers and acquisitions where a European company or a company in Southeast Asia or a US company may see an opportunity. Well, if we could merge, maybe we would get a different tax answer than if we just remained as separate entities. And prior to the 2017 reform, we saw a lot of this cross-border activity where a lot of U.S. companies were being bought by foreign companies, and ostensibly the headquarters, like very little physical would change with the company's footprint other than its corporate headquarters and its tax consequences. And that was something that was very bad for the U.S. tax base. And in some cases, it was bad for some U.S. workers that management jobs would be moved overseas as part of these tax inversions, is what they were called. But what you can do as policymakers is you can recognize that if you're an outlier, as you mentioned, Neil, the highest corporate tax rate in the developed world was something that was sort of a burden on the U.S. You can move that rate more in line with other economies, and you can essentially fix that problem more or less overnight. And that's something that it didn't happen overnight. This was decades in the making, really. But that's something that lawmakers prioritized as a change during the 2017 debate so that the US could be a more competitive location for business investment, both for US companies and for foreign companies that might want to build up their economic footprint here in the US.
Yeah, I often use the example of when Daimler, the automotive company, and Chrysler, the American automotive company, merged together. To your point, they became Daimler Chrysler, not Chrysler Daimler, because for tax reasons, it would have been punitive to the company to have been headquartered in the United States. And so
Yes.
it's not that we stopped having Chrysler or Chrysler cars or manufacturing, but all of a sudden that corporate headquarters and some of that tax revenue was located in Europe because that's what the tax code basically incented them to do. And that's what we were able to fix in 2017.
Exactly.
I want to go to some of our audience questions. And this is a good one that I think helps build on some of our conversation a moment ago. You've argued that pro-growth tax policy will help raise living standards for America. But isn't what people really need lower prices? How does pro-growth tax policy help everyday Americans?
That is a fantastic question. So there's two ways that pro-growth tax policy can support living standards in the direction of affordability. So I'm not going to say that if you change the tax system, all of a sudden prices are going to go down. Certainly, if policymakers change sales tax rates, you might see some prices go down. But when you are providing businesses with certainty and with a tax code that does not punish them for investing, what you're doing is you're expanding the capacity of the economy to produce things. You're expanding the supply side. And when you have a broader supply, there's going to be more general affordability. We were, referencing energy policy earlier. If you have more abundant energy resources, you're going to be able to keep gas prices stable or keep them a little bit lower. And that's really what you're trying to do with a tax code that supports growth and opportunity. Is you want to have the supply side of the economy ready to respond to different needs, different consumer trends, different pressures that you might see from various shortages or things that you might experience with different commodities. But that is really what we're trying to do when we're thinking of pro-growth tax policy and affordability. One thing we haven't touched on, Neil, if I may go there, is tariffs. There are certainly things that you can do on trade policy that directly affect the affordability of different products or services. If you go the wrong direction. And with a lot of the tariff policies we've seen over recent years, we've seen, and you can see in the economic evidence, the different selections that the government makes when it says, oh, we want a tariff on steel or a tariff on aluminum. You can see down through the supply chain, those tariffs increasing costs for businesses and often leading to higher costs for consumers as well.
Yeah, tariffs are a great way to describe kind of a direct cost increase. But maybe I'll go back to our plumber example. If you live in a small town or any town really, and you have one plumber, chances are that plumber might be a little expensive and might be hard to get to come to your house. If pro-growth tax policy lowers the cost of the equipment, the after-tax cost of the equipment you need to buy to become a plumber, maybe someone else is going to come into your community and set up a plumbing shop. And all of a sudden, that excess supply means that you have downward pressure on prices. And so that's what a lot of people, when we refer to supply side pro-growth tax policy, that's really about increasing the supply of things that are available in a way that lowers the cost of the things that we need and want to buy.
Yes, and it's a pro-competition, free market philosophy. Essentially, what you're saying is, if a market is restrained by just one supplier for something, but we can, through tax, and I know tax isn't the only thing, or regulatory policy, make sure that more people could enter that market and compete. Competition itself can help lower prices and provide better quality and availability of services and products to consumers.
So I want to get to another audience question here, and I'm so glad it was put in because it's an issue we another misconception, maybe. And that is that proponents, as we are, and as I know the Tax Foundation is, of pro-growth tax policy, make the argument that quote unquote tax cuts pay for themselves. I don't think I've ever made that argument. I'm not sure, Daniel, if you've ever made that argument, but help us unpack that kind of conception and what's true. And obviously, people here are referring to the Laffer curve, and what's not true about kind of this tax cuts paying for themselves.
Yeah, I appreciate you bringing up the Laffer curve there, Neil, because I think there's a strong lesson from the Laffer curve, but I think it's applied wrongly very often. And the lesson is that there are two rates where you can raise zero revenue, 0 and 100. And in between, there's probably a revenue maximizing rate. And if you're on the wrong side of that revenue maximizing rate, you might be able to cut taxes and the economy would respond positively and be able to make up for lost revenue. I'm not going to say that there aren't examples in the world where this could happen, but I'd say they are very narrow, few and far between. There are some taxes like, property transaction taxes where the rate is so high that the market is just stifled and there's not a lot of transactions going on. This is commonly, outside the US, but you could imagine a scenario where you cut that tax and you get more transactions in the economy and it would pay for the revenue loss from cutting that tax. Generally speaking, though, a lot of times when you're thinking about cutting a tax rate, it's not going, the economic activity from the tax cut isn't going to fully replace the revenue from that tax cut. You could say, oh, we're going to cut the top personal income tax rate from 37 to 35. I think there will be positive economic impacts from that, but I don't think you would make up those economic impacts would make up for the lost revenue. Similarly, on the business side, and this is where you get closer to being able to say some tax cuts pay for themselves, is when you are doing really pro-growth things like cutting the corporate tax rate or applying full expensing. You get closer to the tax cut providing economic incentive for new investment, and that leads to new growth, higher incomes, and higher incomes lead to more tax revenue. But again, it's not a 100% replacement rate. That doesn't mean that we should shy away from all tax cuts because they don't pay for themselves. But it means that we should judge different tax cuts on their own merits. And this is something where Tax Foundation has done a ton of work over the years. We have a model called our taxes and growth model that we use to help lawmakers see the bang for the buck on different tax changes, to be able to say, oh, if you're going to cut this tax, we think that's much more of a much more powerful economic lever than some other tax policy change.
Yeah, it really reinforces the point we made earlier, right? That if not all tax cuts are created equal and tax cuts don't always pay for themselves, it becomes really important to focus on the tax policy that is going to generate the most economic growth and to put your resources, your tax dollars, if you will, into that policy rather than just kind of willy-nilly picking policies and making this argument that it'll pay for itself. These particulars that you've been talking about actually do matter and actually the fiscal outcome of all of these policies.
Mm-hmm. Absolutely.
So we've gotten a number of questions, probably not surprising today, about the government shutdown, and it's a little bit beyond our original kind of remit today, but maybe we can just spend a moment on the concept that we talked about how we like certainty in the tax code because it allows for planning and investment. I think we probably agree that the tax reform bill from earlier this year is a tailwind to the economy and supportive of growth. Of course, that doesn't mean that it completely offsets every other policy or there aren't going to be other headwinds. Is that maybe the way we should be thinking about some other things that may constitute headwinds in the economy?
Yeah, absolutely. I think, one of the things that is almost impossible to measure, but a lot of people try, is the economic impact of policy uncertainty. And this really comes to the fore when you're thinking about a business that has to operate in a lot of different policy regimes at the same time. So maybe it's a business that operates in multiple states or multiple countries, and they're paying attention to a lot of different regulatory requirements all at the same time. And if the one government or multiple governments that they're having to deal with are really unpredictable or create a lot of uncertainty on when a regulation might apply or not, or if they're being sued or audited, it becomes very difficult for those businesses to actually invest and grow. And the government shutdown is, a small example of this. If the government isn't able to provide appropriations for the different agencies that support either regulatory or permitting or different activities that are very meaningful to businesses across the country, then that can be a pretty damaging impact over the course of time. Now, Neil and I don't know how long this government shutdown is going to last, but we've seen them last a couple of weeks. We've seen them last, I think the last one was maybe almost a month. So those sorts of things can create tailwinds. Other things that like we're seeing around the world, and these are really difficult things, geopolitical tensions, wars even, can create uncertainty, challenges for different supply chains. And those are some headwinds to pay attention to. And I've already mentioned the tariffs, but the trade policy uncertainty is another major headwind that even in our modeling looks like could potentially offset a lot of the tailwind from the tax cut bill earlier this year. And that's really quite unfortunate. It'd be nice to have kind of whole of government leaning towards tax certainty, leaning towards stability, rather than policies or debates working in opposition to each other.
Yeah. It would be good if we were pushing all the levers towards growth at the moment. The tax bill was certainly one, but you're right. Tariffs are offsetting that. These disruptions are offsetting that. We kind of need everyone rowing in the same direction. I want to go to one last audience question before we conclude here, because I think it's a great one, which is obviously not everything made it into the one big beautiful bill, and there were ideas that were bantied around, sometimes included, that got dropped. What if you got to write the next bill? If the Tax Foundation got to say, this is the policy that we should include and do the next time, because we want to maximize economic growth in the United States. We want to support a free market. What would you suggest that policymakers put into that next tax bill?
That's a great question. So there's two answers that I'd like to give. One is very pro-growth, and the other is in the direction of simplicity. So one thing that did make it into the big beautiful bill is a provision for full expensing for factories. This is the first time in the history of the tax code that you have an opportunity for manufacturers to immediately expense the cost of building out a new factory. So like the plumbers' vans earlier, be able to supercharge that to a manufacturing facility or certain agricultural facilities. But this policy is temporary. And temporary policy doesn't really help as much as a policy that provides stability and certainty. Really, this is a benefit for a lot of plans that have already been in place. It's hard for a company that might put in a large manufacturing footprint to put together plans and details and already have the work done in the time that this policy would be available over the next 4 years. But I would love to see in the next round of tax policy for this to be something that lawmakers prioritize for the long term. Now, I'm open to some potential tweaks or making it better or making sure it's targeted in the right way to not create all sorts of avoidance opportunities and things of that nature, but that can be a really powerful pro-growth tool. The other thing that I think should be done in the next round of tax policy, and at Tax Foundation we talk about different choices lawmakers make, and one of the things that we have in our tax code is honestly nearly half dozen of different provisions that apply to savings or investment, and we have retirement accounts, educational accounts, health accounts, things your employer is able to do, things you're able to do by yourself, and I would love for there to be just a total overhaul cleanup exercise on those different provisions, because the eligibility criteria and things of that nature, it's really a mess. And I would love for lawmakers to look at a universal savings account with eligibility criteria that would kind of try to be an umbrella and replacement for a lot of these complex provisions for savings. And I think that would, that I don't think that really changes a lot of the incentives to save, because we have plenty of incentives in the tax code, but it really helps the average taxpayer actually understand what savings provisions apply to them and how to use those funds that they're able to save.
I think those are great recommendations. You just let's make it simpler and easier for people to save, and let's make it simpler and easier for businesses to invest in creating new factories and new places of business to help the economy grow. So a great simplification that helps both individuals and families, but also the economy. I hope some lawmakers are listening right now and they take you up on that offer. Daniel, I can't thank you enough for taking time out of the day to join us on the Free Enterprise Exchange. I would encourage folks in our audience who want to learn more about the Tax Foundation to visit them online. I will tell you, they are a trusted resource for us here at the Chamber. They were a trusted resource in my time in government, and they really do great work, not just at the national level, but they're helping a lot of state policymakers transform their tax codes to be more pro-growth as well. So take a moment out of your day, visit the Tax Foundation, and please join me in thanking Daniel, and join us on the 17th for our next edition of the Free Enterprise Exchange. Have a great day.
Thank you, Neil.